All right, guys, look like we got a good chunk of people in here, so 8 o'clock, and go ahead and get rolling. So first of all, thanks everybody for jumping on with us. Excited to share with you a little bit about DRC, what it is that we do, and a little bit about how we go about underwriting our deals and what we look for in new deals. And then most importantly, we want to get to more of just an open forum, open discussion where you guys can ask questions or share stories or tell us about your real estate careers, whatever it is. We really want to kind of be community focused and get everyone involved here and have this be more of a discussion than death by PowerPoint. But not to disappoint on the death by PowerPoint, we do have a PowerPoint for you that we will go ahead and zip through quickly. And then we'll get into the model and then get into some questions after that. So without further ado, let's see, how's it going to let me do this thing? Uh-oh, I'm getting a call. This might be someone trying to get in here. Hello? Okay, they're going to have to wait. Alrighty, guys, so tonight we're going to go through a little bit about DRC, like we said, our team, our backgrounds, kind of how we got into this stuff. We'll talk about our approach, what our acquisition criteria are, what we look for in a new deal, and then we'll put the model on the screen. We'll show you guys our baby that we've crafted over hours and hours and hours, and walk you through a deal that was really cool, really fun, but didn't end up working out. So it's a good one to use as an example. And then, like I said, we'll get into some questions. So first and foremost, like we said, we want this to be collaborative. We want it to be valuable to everybody. So a little bit about how we can help you. So like we said, we're going to teach you about what it is we do and how we underwrite these deals, how we look at these new construction projects. After the fact, we want everyone to be able to stay in touch, network, collaborate virtually, of course. Thank you, COVID. And so we're going to make a little private Facebook group for everybody. Post in that, feel free to, comment, post articles, do whatever you'd like in there. We want it to be a space for everybody to get some value from. And then probably the most exciting way that we can help you. I'm getting an echo. Hey, would you guys, yeah, thank you. Okay, cool. So probably the most exciting way we can help you is, we are more than willing to partner with really anyone that can identify an opportunity. So if you're in this business, and if you're getting into this business, you will learn that one of the hardest things to do is find the opportunities. And so if you're someone that has connections to an opportunity, or you can go out and bird dog something and kind of bring it back to camp, and it ends up being sort of a bona fide and legitimized opportunity, we will bring you into our team. We will partner with you. We'll help raise the capital. We will exclusively raise the capital, whatever the case may be, and we'll figure out a way that it benefits everybody. So that is fully available to everyone, and tonight you will learn what it is that we look for and what type of deal would make sense for us for you to bring our way. So in the spirit of reciprocity, it's good to mention how you guys can help us too. So obviously we're in the real estate world in development, so any connection that you can make for us to any other developers, brokers, lenders, landowners, even like municipal people, like, I don't know, city council members, mayors, planning commissioners, whatever the case may be, anyone in this Metro Detroit market that fits any of those categories that, you're willing and able to make an introduction to on our behalf, that is super valuable to us. You're only as good as the people you know. And so any connections you can make for us, we'd greatly appreciate. It goes without saying we're in the business of raising money. So anytime you can make an introduction to someone that has any interest in investing in development or just in multifamily, that's the lifeblood of our business. And that's really what we do on a daily basis. So everything, any connection that you make, throw a little incentive in there. If you introduce us to someone that ends up coming aboard for one of our deals, and all you have to do is email intro or, connect them with us somehow, and that person ends up investing in a deal, we'll write you a check for $500. So that's how important it is for us to build those relationships, and that's why it'd be really valuable for us. So last but not least, in the world of social media, it's a big way to kind of virtually network. And so one of our goals in doing this tonight is to increase exposure and help us to kind of reach more people. So if you're able to and wouldn't mind just posting a quick story of what we're doing tonight and tagging Alec and myself, we'd really appreciate it. So let's get on in. So a little bit about DRC. So we are a real estate investment and development firm, and we focus specifically on right now ground up development, but more specifically in what we call suburban urban markets. So we like to focus in these suburban downtown areas that, unlike major metropolitan areas, are, you know, only a street or two or a couple of blocks. But for a long time, these suburban cities have solely relied on single family housing options for their residents. And a little bit more recently, they have started to understand the benefits of having multifamily immediately in their downtown area. So we've kind of carved this out, and it's a specific niche that we focus in. And all of our projects, both the current one we're building and then all the ones in our pipeline, are in these sort of suburban downtown markets. So that's where we like to be. Millennials love it. And also, you know, the baby boomer downsizing generation tends to love that sort of walkable urbanism that you can get in these areas. And so that's why we like to focus there. Team. Alec and I co-founded Detroit Riverside Capital June of 2019. My background before real estate was in transaction advisory. So I worked for a consulting firm in Chicago, and it's called Grant Thornton, and we helped our clients buy and sell businesses or conduct third-party due diligence, help them through the M&A process. So it's similar to real estate in the sense that it's deal focused and transaction based, but obviously much different subject matter. Alec was an investment banker and worked a little bit in private equity before we partnered up and started DRC. And we both left those jobs full-time, or left those jobs back in January to pursue real estate development full-time. So as you might have seen on Instagram or LinkedIn, we are currently underway building this beautiful 50,000 square foot building at the corner of Auburn and Squirrel Roads in downtown Auburn Hills. So it's a 48 unit. Those units are on the second, third, and fourth floor that you see there. And then that first floor is 6,600 feet of retail space. The center of the building is a little lobby area with some amenity spaces in there. But we really loved Auburn Hills. It's a great market, super low vacancy. And this building is really kind of the exclamation point of the downtown area. It sits on that major corner, and it's really the last piece of undeveloped land in the downtown. So once we finish up this building, we're really hoping it kind of catapults downtown Auburn Hills to the next level. So there we have it. There's the Jordan. So our approach, first of all, a little bit about multifamily and specifically why we like it. I'm going to kind of burn through some of this stuff, but just so you guys know, we're going to share this PowerPoint afterwards. We're also going to share the recording of the event tonight. And so don't worry if I breeze through stuff, we'll send it out. You guys can read through it later, but just kind of some of the major benefits of multifamily specifically, equity upside, cash flow, very attractive returns, a lot of depreciation benefits when it comes to tax season, great way to diversify a portfolio if you're typically a stock and bond investor. And the way that we operate our deals, we third-party manage, and we stand as sort of the front line in between our investors and the management team. And so it allows our investors to be completely passive and not deal with any of the management headaches and so forth that inevitably come in multifamily. So on the development side specifically, we kind of use this 5-phase approach to benchmark where we're at in our cycle. First and foremost, you got to identify the opportunity. And so we do that through a number of ways. First is through brokers who are representing different pieces of land. A couple of them are on this call tonight. We create relationships with them, talk with them pretty constantly, see what kind of new opportunities they have coming up. Outside of that, we will also just check all the MLS stuff, you know, the LoopNets of the world, the CoStars of the world, and hunt down different listings. And then last but not least, we we'll also just drive municipalities that we really like and look for signs. And honestly, I think that's one of the biggest ways we found a lot of the opportunities that we have in the pipeline so far, is from just doing that. So getting out there and really learning the market and really kind of understanding what's in and around it has been really helpful for us. So after you identify the property, next step for us is to develop the concept and the feasibility. So what that means is, let's say we have a 2-acre piece of land. We need to decide, okay, how much of this land could we actually build on, and how much of it do we need for parking or setbacks or wetlands or flood zones. So that typically ends up being about 70-30, about 30% buildable and 70% reserved for all that other stuff. Then from there, density plays a factor from the city in terms of how many units per acre we can have. And so we take into account that information. We look at what sort of density, what sort of parking requirements the city needs for each unit. And so that helps us plan out how big the parking lot needs to be. And then from there, it's really just this kind of meshing these puzzle pieces together between, size of rooms, size of the building, height of the building, and coming up with a number of units and a cost per square foot that's going to make sense. And we'll get into more of that later when we get into the model. But that's really what happens during the development, the concept and feasibility stage. Then what, I guess a big part of that too is getting with our architect. They help us with all that stuff, and we have a great relationship with Design House Architecture out of Rochester. They will help us work through all that stuff, and basically together we produce a conceptual site plan. So then that takes us to phase 3, the planning and financing stage. There we will take that conceptual site plan to the city's planning department and also the seller sometimes, and kind of rope them in on what we're trying to do and get them excited about it and help them understand that we really want to make something happen on their piece of land. So we go into the city and pitch to them the idea, give them a look at the site plan. We always go really preliminary at first, and that's really important. We just had a meeting last week where we only wanted to build a certain amount of units, but we went in there and said we wanted to build 50% more than that. And that helps to kind of benchmark high, because the city's always going to fight you on density, especially in a lot of these smaller downtowns. They always want less units when you obviously want to maximize units. To maximize the financial viability of the project. And so that's what happens during that planning stage. We go in and meet with the city and work through the city approvals. And with that, there's kind of a couple of stages. You got site plan and then site plan approval. And once you have your site plan approval, then you work towards your building permits. And then ultimately that leads you to the 4th phase of the development approach, which would be the construction phase. So this is what we're in with Jordan. We've gotten through all the permitting, all the approvals necessary with the city, and now we get to do the fun part, actually build the thing. So that takes, on the short end, probably 12 months, and on the long end, maybe 24 months to get through all that. And then after we complete construction, or I guess as we're nearing the end of construction, we start to focus on the pre-leasing process. Ideally, we like to open the doors to the apartment, or we would like to open the doors to Jordan with, say, 40% occupied, 50% occupied. I mean, obviously 100 is desired, but kind of tough to pre-lease everything. So we like to start that pre-leasing process while we're still building, get leases signed, get people ready to move in, and then quick dash once we have C of O to then try to fill the rest of the units. And that's what happens in phase 5. We basically operate, and eventually we'll sell the development or refinance. So in a nutshell, in 5 minutes, that's the entire development process from start to finish. In reality, it's many, many months in each of these stages, where you can kind of see at the bottom some of the estimates, but typically it doesn't go that quick, and it takes even longer. And that's kind of one of the challenges of development that we've noticed when it compares to, say, a value add strategy or other types of real estate investing, is that the development timelines are just so much longer than what you'd find in other transactions. And that creates challenges for, internally for DRC as far as our revenue models and what we have to do to kind of support our business, but also for investors. They have to go, 12 or so months cash flow free. with the promise that once we build and stabilize, we'll start some healthy cash flows. So definitely one of the complexities and challenges of development is that timing, but nonetheless, that's the world we chose. So here's a little bit more about our team. This is kind of the basic structure and just a visual of some of the major components that it takes to make some of these deals happen. So we get the deals in from the listings and the brokers. We plan them with our architect, and then we raise the capital through equity investors and then some of our debt lending relationships. And then we lean on all these consultants that you see at the bottom. So our lawyers, our architects, civil engineers, our general contractor, a lot of collaboration with the municipalities as well during these processes, and of course our property manager to eventually manage the property after we get it done. So that's just kind of the core group that you need to make these things happen, and it's really, really important to build good relationships with all of those people because they ultimately really control the success of your project. Without Tower and their ability to meet a budget and stay in a timeline, our project could easily go bankrupt. So you really have to trust these people. You got to pick the top ones in your area. And if you're in our area, we highly recommend all these people. They are a joy to work with, and like I said, enormously helpful to our business. So that gives you an idea of our team. So now a little bit more on what we look for in new developments, kind of some of the critical criterias. And these are a little bit biased to the idea of just repeating the Jordan design. So the Jordan is, on a 1 acre piece of land, it's a 50,000 square foot building, and it's in a downtown. And so a lot of these criteria kind of play to that. When we get away from that model a little bit more of a unique design, then some of these can kind of mesh and change, but nonetheless, this is kind of what we're working with. So we like to see land at least an acre, if not more. Typically 2 to 3 is preferred. Never pay more than 25 grand per unit for the land. That's a really big one for us because if that's kind of a fixed cost that is tough to overcome. If you're too much higher than that cost per unit, it's tough to really turn a profit on the deal once you add in all the construction costs. And then we'd like to be at least a half mile to downtown. Like we said earlier, that's kind of part of our core strategy is to be close to these downtowns. So half mile is good for that. Like to see average market rent of $1,200 for the Class A and B properties. And we like to see 60 grand or greater in median household income from the 5 mile radius. And then love to see a vacancy less than 5%. So that's kind of standard in multifamily underwriting. People use 5% as a proxy for acceptable vacancy. So if the market's doing more than that before you've even gone and built new units, really tough for them to absorb into the market and for you to hit your target rents. So really important that the market is averaging less than 5%. So in the case of Auburn Hills, for example, the latest CoStar that Alec pulled yesterday was 2.4%. And so that's excellent. That means that our apartments are, knock on wood, gonna absorb right up into the market. So that's what we like to see when we're looking at new deals is less than 5%. Then of course we need the city to buy into multifamily. So it's either got to already be zoned multifamily or they got to be open to a rezoning or a PUD, which if you don't know, a PUD is basically they just toss the zoning ordinance book in the trash and they rewrite all the rules for you. And that's kind of a stretch of the truth. I mean, but basically they determine all of the new ordinances that you have to follow through the PUD. And it really prevents you from having to get individual ordinances for every single one that you want to break and go into the ZBA, the Zoning Board of Appeals, and going through all that stuff. So PUD is definitely preferable when it comes to the zoning if it's not already multifamily. Excuse me. I don't have corona, I swear to God. Okay. So this is something quick we threw in here. We focus on development, but we're not opposed to the value add strategy. That's the process of basically buying existing multifamily, renovating it, improving occupancy, reducing operating expenses, raising rents after the renovation, so on and so forth. And these are kind of the basic steps of that process. So you come across a good value add deal and you want to send it our way, we'll gladly take a look at it, but not exactly a focus area of ours right now. So good news is We're only 20 minutes in. The PowerPoint portion is over. So now we're going to bounce into the model here. Alex is going to spin you through some of the, let's see, I think I'm going to do this. Well, that's just for us to see that one. I go here. Ooh. There we go. Yeah, it's sharing the red. Okay. You guys can see that, right? Anyone? Bueller?
Yeah.
Okay, cool.
Right on. So,
man, isn't she pretty?
so this is a deal that we took a look at in Hazel Park, and Hazel Park is an area located in the suburbs of Michigan. It's about 15 minutes from downtown Detroit, and this property was located roughly an eighth to the downtown of Hazel Park. Well, actually, downtown is up and coming. And here's a little rendering of what it would have looked like. We took a look at this deal because they were selling it for roughly $2 million for 6.6 acres, or relatively around there. So quite a bit of land. It was right off of I-75 and 696, and very close to other local upcoming cities like Ferndale, Royal Oak, which is a very big city in the suburbs of Detroit, or metro area. And we proposed on this piece of land roughly 200 apartments, and the total square footage came to roughly around 196,000 square feet, comprised of studios, 1-bed, 2-bed, and 3-bed apartments, ranging from $1,000 to $2,100 per month. We essentially worked with our architect design house on getting these numbers estimated from a rent standpoint, as well as from a per square foot standpoint. So that's kind of how we got to these numbers of 196,000 and 200 units. As we go down here, our total project cost for this entire project was roughly around $32 million. We went with for example, for Jordan, we went with a 80 to 20 loan, or 80% to 20% loan to cost. For this example, we were underwriting this about 4 months ago, and COVID hit, so we were being more conservative with our loan to cost estimates at 75%. Could even go to 70%. We've spoken to a lot of debt lenders lately, and right now they're getting much more conservative with how much they're willing to loan out for new developments such as this. And to actually back up a little bit, the reason we ended up not going through with this deal is we didn't think that, Hazel Park, like I said, it's an upcoming downtown, and we didn't know if the downtown could absorb 200 units. And so we were a little bit skeptical of that, and that's why we backed off a little bit. As we scroll further down from a construction loan, we projected at a 4% interest rate, and this is everything that's blue is hard coded, and this model is pretty automated. Not everything is automated, but relatively pretty automated. So if we were to change that, it would change many of the numbers in the analysis. So for this example, though, we went with a 4% interest rate. Could be much lower right now, as everyone probably on this call knows. Interest rates are at a relatively an all-time low, very low. And so we're conservative with this one, though, at 4% for the construction loan, at a 2% or 2 years of interest only, which you'll see in the 10-year pro forma. And for the long-term loan, it was at 4.25%. We're expecting to build this building at roughly $125,000 or $125 per square foot.
Oh, no, $125,000.
$125 per square foot. And the way that we got to this number is constantly collaborating with our general contractor and architect firm to get to a number of $125 per square foot. Industry norm is, from our general contractor from the Jordan is, charging a 5% builder's fee. So it's typically industry norm, and then a construction contingency of 2%. We also have a project contingency of 3%, which you'll see in the tenure or in the source and uses. Obviously, so to get to the rents, the pro forma income rents, as I already mentioned, the rent prices and the unit mix, an industry norm as well as underwriting these deals at 5% vacancy, and anything that is 2% or better than that, it's it's a great deal. To go further down, obviously, we make money off the apartments and whatnot, but we also like to include some other income. So we have internet income, tenant storage, premium views, pet monthly fees, late fees, and carports. And then other income that are one-time fees are, applications, administration fees, pet registration fees. And we get down to here, which is our total project income at stabilization.
Quick thing to mention here too, you see that this little number right below the 3.6 million. So just to kind of summarize what Alec just said, the apartments themselves would have generated about 3.4 million net of vacancy, and another 165 grand from the other income, and then totaling up with this one-time stuff about 3.6 per year. But it's tough to contextualize that across different projects because they're different sizes and cost different things to build. So one of the most important numbers, and it's kind of funny that it's so small and indescript down here, but is this income per square foot. That compared against what our cost per square foot is gives us a direct look at ROI. And we like to see this number at least above 17. If we're building somewhere around 120 a foot, then we can support income around 17. But if we're up into the $130, $135 a foot range, we need that income per square foot to be in the 18, 18 and a half, 19 range. And in Jordan's case, it's like 19, 20. And that's total square footage. So you can't really connect it to your income per foot in the individual units because it's calculating it across all the square footage of the building. But we just kind of had now used it as this major metric that helps us make sense of all that. Another one's up here, this average effective rent. That's just a weighted average of all the different units and all the different rents. So those are kind of the two main numbers in terms of analytics that we like to look at on this page.
Yeah, I also like to add too is the way that we came up with these rental prices and other income expense charges was by looking at the comps. We have a CoStar account and look at all the comparable properties, see what they're charging for pet fees, what they're charging for 1-bed, 2-bed rents, etc. So that's how we ultimately got to these numbers and justified them. To go over here, so our operating expenses, this is for pro forma expenses. Our operating expenses, for this deal in particular, we put at 32%, which is roughly around $6,000 per unit. We've spoken to our many property management firms and done a lot of industry analysis, and typically $5,000 to $6,000 per unit is roughly where the operating expenses should be around. So if you're much higher than that or lower than that, I'd do some diligence and ensure that.
So for all you value add guys out there that are looking at this and saying you guys are insane for thinking you can operate at 32%, a couple of things. When you buy in the value add world, typically the rents are lower and the expenses aren't proportionally as low. So there's less variability to them as compared to in this world where we're getting top dollar Class A rents and we have the most efficient building with the least amount of maintenance. And we also have a 3% property management fee, which in a lot of other cases that can be 4 and 5%. So this comes straight from the property managers who manage a lot of new constructions, and this is what they say. So just want to add some more context there if that seems low to anybody. Anything else on this one?
No. Well, I was going to say so you guys are probably wondering how we, for putting these deals together, how we essentially get paid. We typically charge a 2% acquisition development fee. Obviously, sometimes we underwrite these if the model works or if the numbers work, 2, 3, 5, or 4 to 5%. So for this deal, we underwrote at 2%. Also, we typically grow our operating expenses at 2.5% because we typically grow our multifamily income by 2.5% per year due to the fact of inflation. Down here, this is how we've essentially, pitched to, or for at least the Jordan, we've pitched to investors that we'd like to typically sell the property in the 5th year or refinance the property in the 5th year and, sell in year 10 or, when the time is right. But also ultimately we want to obviously return capital within some 5-year period, whether that's through a refi or sale. As a market exit cap rate, we went with, or we typically go with 6.5%. This is typically what we've seen, brand new ground up developments getting sold at least in this, economy right now. And
yeah, skip it. Yeah. Okay, so those are all the good inputs that kind of drive some of the basics of the project. The source and uses here is basically the project's budget. So this looks at where am I spending all my money during this project and where am I getting all my money from during this project. So the latter is over here on the left, and in this case, it's a simple financing mechanism between debt and equity. But in some like affordable projects or even in some market rate stuff, this table can get really complex if you start looking for tax credits or PACE loans or other various forms of debt and equity that aren't so straightforward as just greenback cash and a loan from a bank. But that's typically how we've approached deals so far. So then over on this side, starting with the lion's share of the cost is just going to be the construction hard costs. We underwrite it again at that $125 a foot. That's how we estimate our cost until we can actually get our general contractor in there to hard bid everything. And you can't do that until you have a full set of architectural plans drawn, full set of civil drawn, and they can actually go out to the trades and get certified hard bids. So it's this constant guessing game, informed guessing game with the general contractor where they're using their own estimates. They're using stuff like RS Means, which is just a big construction database that helps to estimate costs in various geographies. And then they start to like soft bid some stuff. So they'll call up their favorite trades and talk to them about the particular type of building. Hey, it's about this big. There's this many rooms. What do you think on this type of cost? And you really take it from here kind of down to here. And all the while, we're kind of pushing them to do as much of that as they can, as soon as they can, before we've spent any real dollars in pre-development. So before we spend on a geotech survey or a phase 1 or any of the other potential pre-development costs, we like to get a really good understanding from a general contractor that he's going to be able to hit this number. And if not, the deal's dead. Because there's basically nothing in this model that's more sensitive than that number. Basically, for every $1 of square foot that you're adding to that, so from 125 to 126, you just added almost $200,000 to the overall project cost. And so you can imagine how drastically that can swing your overall return numbers and your capital needs and return on equity numbers when you do that. So very, very important number there at the top. In this case, paying $2 million for land. So on 200 units, 10 grand a unit. Am I doing my mental math right? Yeah, right there, bang. So we said before, 25 grand a unit is kind of our threshold. In this case, we're well below that. So really good efficiency on land costs. Architectural is, typically we just work with Design House to get a good estimate from them on what they think it's going to cost. They base it on square footage, and then we kind of massage it around what we need it to be to make the numbers work. And, there's various levers that we can pull with them to adjust the costs if we need to. Engineering, this is civil stuff. Legal costs, mostly wrapped around title and recordings. That's stuff at closing, like with the title company and for them to monitor all of the draws throughout the construction process. Like we mentioned earlier, we work with a really good set of attorneys over at WWRP in Birmingham, and really good attorneys are really expensive. So you need to have a lot of money budgeted. In this case, we said $90,000 for this particular deal. That's one that doesn't really scale in size with the project. And in all honesty, this could probably be half of that, because whether they're writing operating agreements for a 50 unit project or a 200 unit project, they're pretty much the same. So it's not a whole lot of extra work. So honestly, that one could probably scale. But anyways, I'm not going to go through each of these individually because I want to get to some questions here, but and some discussion. But you can kind of see all these different categories that we budget for: financing fee, taxes. If there was retail, we'd have a broker commission, insurance and this is builder's risk, et cetera, so on and so forth. Marketing budget, this is during lease up. Design consultant, we pay a designer to help us select all the finishes, carpets, flooring, cabinets, countertops, paint, all that stuff. Furnishes equipment, it's like lobby stuff or, a ping pong table in the example of Jordan we're putting in the lobby. You can see debt fee here. So Alex said it can range 2, 3, 4, 5%, but in this case, it's such a big project that 2% worked in the numbers and worked as far as we were concerned. And then this is one of the most important pieces of this whole budget is this contingency here. 3% contingency might seem like not a lot to a lot of you out there. You think about a $32 million project and we're only going to budget not even $1 million for unforeseen stuff. One of the major reasons that we're able to do that is because we have what's called a GMP contract from our general contractor. So that stands for guaranteed maximum price. And don't be fooled, it's not truly an actual guarantee, but it does protect you in many, many ways that you otherwise would not be without it. So for example, COVID just hit, lumber prices went through the roof because they stopped making lumber for 2 months. Demand stayed strong, everyone's still building houses, and so we got hit with a $42,000 force majeure change order because basically Tower said, look, there's nothing we can do about this. I mean, lumber prices go up, we quoted it before COVID, now it's after COVID, and we can't do anything. So in that case, you can still have some stuff outside of the GMP that can get you, but there would never be a situation where they just forgot to include something in the budget. That would all be their issue to deal with. If they forgot to quote the balconies on the building and just didn't have a line item in our budget for that, and we had already executed our GMP, they would have to figure out how to pay for those and get those done. So that's the beauty of the GMP, and that's why we can operate on a much more lean budget. And worst case scenario, we go raise more money. So that is definitely a worst case scenario, but it's one nonetheless. And knock on wood, we hope we don't have to do that during Jordan. It's not looking like we do. We actually haven't spent $1 of our construction contingency, and we've only spent 5% of our project contingency thus far. So really fortunate there. So that's really the kind of game plan, if you will. The playbook for the development is all of these costs, and this is basically what I really focus on during construction is matching all of our actual spending to this stuff and making sure that we stay on budget. Let's really breeze through this stuff because we're getting kind of close on time. So
really fast, these next two tabs, stabilization year 1, year 2. This is for this one, in particular, stabilization year 1. This is during the construction period. As you can see, these numbers are hard coded for an estimate of what we project that we could pre-lease during this time period. So this construction, you want to go to the next tab. This construction would go on for 16 months, and we spoke with Tower, and they gave us an estimate of how long it would typically take. As you can see, we're being pretty conservative during our lease period. At C of O, certificate of occupancy, we're at 50 units rented out at that time. Obviously, we have 200 units total. So you can see, obviously, in the 16th month of the C of O, that's when revenue starts to come in. And
So this is really important for cash flow purposes, right? Because basically, you have capitalized dollars and then you have operating revenues. And so our capital needs to cut off here in the 15th month, and then it needs to pick up with our operating revenues right here. So we have to survive until here on our loan and on our equity raise. And then here we start to get revenue in from actual operations. And that kind of starts the second half of the financial picture, which is those operating years. So this helps us to understand how it's going to impact this, which is a 10-year outlook on cash. Alec, why don't you walk through this?
Yeah, so obviously the stabilization leads into year 1, year 2. Year 3 comes from our stabilization input tab. Going down in year 1, you can see that we have a interest expense of $442,000, and it shows a negative amount of cash flow for that year. However, we actually budgeted for that in our source and uses. So that was actually a line item, if you guys missed it, in our as a use for raising more capital in order to cover that interest expense. So obviously we could be able to pay for that. Like I said, 32% for expenses as a total, or for total operating expenses.
So this is just a proxy, guys, because here we'd normally, like when we'd actually get to a bona fide deal of raising capital for, we would go through and itemize out what all of our operating expenses are going to be. This just lets us do it really quick and uses a broad stroke assumption based on our GI. But once it came down to it, we would go through and actually formalize what the operating expenses are, what the property insurance is going to be, get a real quote from our insurance broker, and then we'd go and talk and sit down with the city assessor and get a bona fide estimate for what our property taxes are going to be, and we'd fill all this stuff in, and it better be close to that number.
And additionally, to add to that is, we work with our property managers as well to really solidify these numbers as operating expenses to know that, or to justify that we can hit them.
Mm-hmm.
As I mentioned earlier, we had a 2-year interest only period. Your principal doesn't start to kick in until year 3, and then capital reserves, we budgeted at $60,000 per year. This is based on units, right?
Yeah, I think it's $300 a unit or something like that.
Per unit, which we worked with our property manager and came to that estimate.
This is also a lender thing. The lender requires this. So this is really, this is your money, if you will, or our money of this project, if you will. So you could add this to this, but you're just not going to be able to pull it out of the bank. The bank makes you keep it in there as reserves, and it's smart too, because, in the example of COVID, let's say you had to go a month of starving cash flows, like no one paid their rent for a month or something like that. Like that's when you lean on these reserves. So you don't want to underwrite with them, because you don't want to inflate returns to a level that investors will never actually see during the hold period, but they would get all this money at sale. So it boosts your sale a little bit, kind of marginally. Mm-hmm. Down here, cash on cash return is just taking this net income and comparing it with our total equity raise. So you can see over the 10-year, we're averaging about 13.5 or 14%. Average cash. So that's just from the operating piece. But, okay, I'll breeze over the analytics here. I'll get to the capital piece in a second, but these are some of the core analytics we look at. Debt service coverage ratio, just what percentage your net income represents of your total debt payments. So in this case, we're 1.73 times net income to debt payments. Net operating income to debt payments. You got to be over a 1.2 or 1.25 typically. Debt yield, just what you're yielding off your debt. Market value is just based on the cap rate and the NOI, and price per unit, et cetera, whatever. These are just here for reference if we need them. So this is the fun part. Here are the return summaries and the waterfall schedule. So in this case, we could fill this in. We didn't, whatever. But typically we'd have like a preferred return. So our offering to our investors is normally something like, we'll pay you an 8% preferred return, and then we'll do a hurdle split over that. So we would get, call it an 80-20, a 70-30, a 60-40, where they're getting 60% of everything over that 8% amount, and we're getting the reciprocal of that, the 40% in that case. So we can model that in here if we want. It's just not.
For the deal, we did a hurdle rate and we did 10%.
Oh, good point. Okay, yeah. So I'll show you that point in a second. And then here we show liquidation proceeds. So like this sale price just comes from NOI in year 5 and then raised by the cap rate. Loan principal is what we have left on the land or on the loan. Sale costs are 3%. Personal guarantor, this is something we didn't touch on, but a lot of you are probably wondering how we get a loan for $24 million. Definitely not our credit scores, that's for sure. It is a process of getting what's called a loan sponsor or a guarantor, and basically that person signs for the loan and they say that, all right, if this project fails to pay the loan back, I will personally pay the loan back. So you can do that with an individual person, or you can do a pro rata share of a guarantee just based on your equity holding. In the case of Jordan, we did one individual person who was one of the largest investors. He basically got a separate deal that said, okay, independent of your investment, you will also receive this fee for your risk of guaranteeing this deal. And so it's in no way tied to his equity performance. His equity performs just like everyone else's does. But then he also has this added benefit over here that says you will get this fee basically for guaranteeing it. And then should you have to come out of pocket, the fee helps to offset those costs. So it's no real risk to that person until the overages cost more than the fee. And then it would actually be out of pocket expense. It would be temporary out of pocket, but they would end up getting reimbursed by the fee is the point. So anyways, almost done here going through this, and then we will get to some discussion. So this kind of breaks down total project proceeds. So at the project level, in this case, annual cash flow, return of equity. So this was the 8 million that we put in. This 6.6 here was what we pulled out at sale right up here. So that's net of the initial investment. And then you can see some of these major project level returns. So over 5 years, this would do a total of 125%. And that's about a 24% IRR based on these cash flows right here, these total cash inflows and outflows. Once you take out some of our fees and such, you get to this picture here. So this would be like the LP total, and those are their cash flows, their return of equity, their profits from the sale. And then in this case, we were taking just a 10% carried interest. This is what Alec was referring to earlier. Instead of doing a hurdle rate, we just took a 10%. We were going to just take a 10% carried interest from day one. So basically from day one, we own 10% of the project. Our limited partners own 90% of the project. And so in this case, you can see the effect of that either here or here, where these would be our proceeds. And then we're also including this in our proceeds because we presume that we could sell this project, or at least contribute to selling the project and maybe split a broker fee with someone like a buy-side broker or something like that. So that's why we have this in here. It probably wouldn't end up that good for us. We'd probably have to spend a lot of this to actually sell the project, but it just gives you an idea of the potential of these things when they get this big. So that's really kind of it. Over here is just a debt schedule, and that's just really boring and breaks down all the debt. So I am really sick of talking at everybody and really want to hear from everybody now. So what we would love to do at this time is do exactly that. Stop talking and hear from everyone. So thank you guys very much for sitting through that and listening. I hope you guys found that valuable. And we will, like we said, we're going to share the recording of this with everybody after the fact. And then we'll also share the PowerPoint from earlier. And yeah, with that, would anyone like to share a comment, question?
Yeah, Michael,
anything at all? We are an open book. Just feel free to jump in.
Yeah, can you guys hear me?
Okay, try now.
Hello, can you hear me?
Yeah, we got you. Okay, who's talking?
Perfect. This is Camden Smith. How you doing, Michael?
I'm doing well, Camden. How are you, my man?
Yeah. Hey, so wanted to jump in. Obviously, you guys bring some experience to the table from your previous careers. Know your weight on Excel, pro formas, everything like that, market analysis. Give me some context as to where additional expertise come from as far as real estate goes, because you guys don't have a background necessarily in real estate, or maybe you do. But what sort of mentors do you have available to you? Who's guiding you on these deals you're doing? What
Great
other
question
have you tapped into to gain some insight and some additional education as well?
Yeah, absolutely great question. So you're right. We had actually zero real estate experience before the Jordan, literally none. I'd never even bought a house. So 100% of our knowledge came from mentors, and got to give a shout out to David Tupin. He was a huge help to us early on in kind of teaching us about how multifamily works. And in that case, we were always talking about value add deals, but it's obviously really similar to a lot of this stuff. So we followed him on social media, had a few calls with him, and he kind of gave us really early on some of the initial ropes of how this stuff works. And then other people like him, different podcasts, Bigger Pockets. I like Evan Holiday's podcast, Monumental. That one's really good. I like the Apartment Investing Journey with David Robinson. That one's really good. So various sources like that of just general knowledge that helped us to kind of learn the terminology and the basics of all this stuff. And then I would say more technically speaking, on the construction side, it's all tower and design house.
Yeah.
Those guys know, I mean, jump in if you want to.
Yeah, no, I mean, when we were going through the initial, once we were talking about the construction and everything, most of the discussion was Chinese to Michael and I. And, we obviously were able to do the analysis, build a pro forma, speak with the mentors, obviously, that we have in our network, and, really understand that if this deal can work or not, or work. But we really relied a lot on design house and tower construction when it came to the construction side of things. Yeah, I think people were.
Oh, wow. Lots of questions in here. Okay, sorry guys, we didn't see any of these questions in the chat until right now, so we can try to zip through these. Okay, but yeah, Cameron, I hope that helped to add some clarity. Other than that, too, like I got to give a shout out to my dad. He's been a huge help for us, and he's a partner and advisor at DRC as well. He just helped us kind of dissect some of this stuff early on when we're looking at all these major budgets and talking with lenders. And, he was a great sounding board for us to ask questions to. He's been a long-time serial entrepreneur. He owned a 401k plan company for a long time. And so he was super helpful to kind of help fill in the gaps in between the podcasts and the consultants and everyone else that we had around us. And there was 3 or 4 other people like that. A couple of our investors were more experienced in real estate and were able to shed some light as we were kind of bringing this to them. And most of them were kind of from the friends and family realm. So that helped a lot as well. So I want to fire through some of these questions that you guys asked in the chat. Serious question. Does anyone know how many vacant buildings in Detroit the Illich family owns? I don't, but that's a great question. Is that including your prop management fee? Prop management fee would be in that 32% of operating expenses. That would include the property management fee. And in the case of Jordan, we're at 30%, and that includes the 3% fee. Hope I didn't miss his first few minutes before I joined. Can you walk through the process of how you guys got started as developers, gathering, saving capital to inject a new company, building network for future potential? Basically, just the whole process. I'm 20-year-old from University of Guelph. Is that how you say that? In Canada? Aspiring to be a developer myself. Right on, Julian. That's an awesome question. We highlighted like a little bit of that, but it's a long story. The short version is a lot of hustle, a lot of grind, a lot of asking questions, a lot of talking with other people we mentioned. Found a good opportunity through a broker. We're able to develop a business plan that made sense to investors. We're able to connect with enough investors to raise the money we needed. We were able to connect to the bank we needed to raise the debt, connect with all these other consultants. And that's such a sorry answer because it's so much more than that, and that makes it sound so easy. But really, that's kind of the long and the short of it. So I'm happy to jump on the phone with you at some point. I can tell you more about it. Pre-LOI assumptions directly from the consultants, or do you gather them online? Kind of a mix of both there. Like Alec was saying, we talk with, like in the case, like, okay, so architectural fees or whatever, like what that's going to cost. We just talk with design house. Cost per foot, we kind of talked about, but like we'll go back and forth with tower. We'll show them the design. We'll get specific on how we're going to build certain things, and they help us to kind of vet a lot of those numbers. As far as like costs of like phase 1 reports, geotech surveys, legal, all that stuff, we consult with those people ahead of time. Like insurance, we get with our mortgage broker, consult with him well before we close the deal, just to make sure that the numbers we're carrying in the budget are enough to support. And we really try to vet everything on that sources and uses as much as we can before we close, because once you close, that's your Bible, and you're held to that by your lenders and your investors, and you can't really deviate from that too much. Do you want to answer that one? Do you close a separate agreement? Oh, with the guarantor with the other limited partners. That's a great. I actually dealt with that. You want to explain that? This one. Yeah. So, so the guarantor relationship was public to the other investors in the sense that they knew it existed, but the actual document between us and him was, well, like the negotiations and such was not in there, but like overview information about like his fee and such, like all that was in the budget. But the specific negotiations were just between our GP and him and his attorneys.
I think we already answered this one, Sean, of where our investor pool came from. For this initial investment with Jordan, we really reached out to friends and family for this initial deal, and built that investor network over the time period of constantly networking with institutional investors as well as additional friends and family throughout the process.
Okay, rent per foot on Jordan, like 2 to 215, somewhere in there. They're smaller units, but we're gonna be some of the higher rents in the market, newest build, and we got luxury finishes, LVT, quartz, nice cabinets, the whole nine. Stainless steel appliances. Everyone loves to flex those. How does one find investors? Mainly through your circle of influence, or there are many other ways. Definitely through your circle at first, and then it can grow elsewhere after that. How'd you guys find the construction loan? This part so the deal itself was a long way through the entitlement process when we came upon it. So there was already a lender that was looking at it with the sellers, and the sellers were just having trouble raising the equity. So we came in and used that same debt lender, and we've maintained a good relationship with them, and we're looking to use them on other deals as well. So it was a little bit easier in that way. But other than that, you can use like mortgage brokers. Like we got a good relationship with a guy over at Berkadia. His name's Luke Safernack. I hope I said that right. Highly recommend him. Dan Kearns at JLL in Chicago. He's a great debt broker too. Charlie Cristofalusi, if you're looking for HUD or what else do you do? Like Fannie Freddie stuff. Another good one. Any of those guys, highly recommend. Reach out to them. They can help you find loans. What's the next in-house DRC branch you guys foresee, i.e. accounting, project management, media? Great question, Ben. Yeah, honestly, so that.
Yeah, no, we're for the next in-house DRC branch that we'd like to implement is definitely property management. We think that, especially for the Jordan with the size, we can definitely manage ourselves going once it's already pre-leased. Obviously, for this first development, we want to learn and make sure that we're correct about that statement, because it could be much harder than we think. But from what we've seen seen throughout this entire deal, I think that that's somewhere that we can definitely save and create cash flow for ourselves throughout the process.
I gotta clarify though, in case KMG catches wind of this, we fully plan to use them for Jordan, but this would be far beyond down the road. Like once we have scale, we'd be able to justify bringing it in-house, and that's a logical move that a lot of large managers will make. And so ideally that's an area that we could add to, but I've also heard horror stories. I've heard, like we mentioned David Tupin, he said he will never self-manage, never bring management in-house because it's just too much of a headache. He'd rather not deal with it because there are big guys out there that just won't do self-management. But maybe someday we might. We also want to get like into the supply chain of it. Like I think that stuff's really cool, like where we're buying the stuff from and like sourcing stuff. And actually I got to use this opportunity for a shameless plug of the latch system. So this thing right here is badass. We're putting these on all of our doors, and this thing is like a fully automated lock that goes right on the deadbolt. You use your phone, a key card, or a passcode to access this thing. And there's a little camera right in the center there, so it takes a picture of everyone as they're going in and out, but only the guests. So like if you live there, it doesn't take a picture of you, but if like a cleaning person's coming in, like it photos that person, or if one of your guests is coming in, like it photos that person, keeps a whole management log. So super, super cool. We're actually a distributor for these guys. So if you know anyone that wants to incorporate these into the projects, big time finder's fee, referral fee for you if we close that deal.
It's called Latch because a few of you guys asked what the name is. It's LATCH.
Yeah, LATCH, like a door latch. LATCH. This is like the C series, but they make it in an M series as well, which is a bigger one, and it has the actual door handle on it. This one, you just use any door handle, and this just handles the deadbolt portion. But yeah, this system is super cool. It's a full software system, full app. You can like text someone the code to get in your room. You can unlock your door from anywhere. Like completely gone are the days of like losing your key, getting locked out, changing locks, like the whole management burden of all that stuff is eliminated with these guys. So we're super excited for this. And like I said, you know, anyone renovating apartments, you know, anyone building apartments, if we can get these things in there, you know, like we said, we're a distributor for them. We can sell it to them, and we'll pay you a big commission for that. So shameless plug on that.
Hey, Mike,
is that
Wi-Fi or like how's it powered up?
So I get close to the mic, Ben. Can't hear you.
Hey, so is that like, do you use Wi-Fi for that, or does it hook up to the Wi-Fi? And how's it powered up? Is it battery or is it hardwired in?
Yeah, good question. So it's battery powered. There's 8 Duracell batteries in the back of that thing. But the system itself operates on Bluetooth. So it has a Bluetooth in it that, like, when it connects to the phone's Bluetooth, it can sync up and actually unlock the door. So you don't need to hardwire each of the individual units, because that would be a huge expense. Running low volt to all the doors would be really expensive. So you can avoid doing all that because the whole thing runs on the Bluetooth. And then every time you open your door, it takes all the data from the Bluetooth, from the reader, and sends it into the management portal through your phone's Wi-Fi, or your phone's data, whatever it is.
Nice.
Are you guys guys, I kind of want to start, like, just unmute your mic and just ask the questions. I'd love to just hear from you guys too. If anyone wants to jump in and ask one. I guess there's a few here.
I have a question if you're taking them via voice here. Name's Travis Gear. I've done a couple developments, ground up, medical office mostly. So the development process length is pretty long, and given the current state of the market, you know, it seems like we're relatively far into it. What kind of things are you guys doing to mitigate risk for like the length of the market cycle?
So do you mean specifically like related to COVID, or do you mean like the length of the development itself, like how long it takes to build the project?
Yeah, so the length it takes to build the project, and then also how long we've been in kind of a bull real estate market.
Yeah. So length on building, like, that is a huge benefit of using towers, because a part of that GMP contract stipulates a finish date. And so if they go beyond the finish date, like, we don't have to pay additional staffing costs for them. Our risk is interest expense and missed revenue. So of course, those are huge deals. And in fact, on Jordan, it's like $3,000 a day that we miss. But the key to that is really, I mean, every single day we get an update from our superintendent as far as what happened on the site that day. We benchmark that against our schedule, make sure we're staying on track with kind of the major milestones, and that really helps to kind of move us along. As far as the market cycle with kind of the bull market we're in, I think you are correct. It has been a very long bull market, obviously since, you know, the 08 situation, and COVID didn't really recorrect it like a lot of us thought it would early on, at least so far. Big time knocking on wood. But I think that because apartments are typically like a recession resistant asset class, I'm confident that will remain through the first downturn. I think a lot of people go from, you know, houses to apartments in that type of environment. So I think naturally we're kind of inherently in a protected position. However, being Class A and being high end of the market, that is definitely a risk, because those are normally the apartment market compresses, and the A class renters go to Bs and the Bs go to Cs. And so in our case, that could affect us. But we have about 30% vacancy. Like, we have a 30% sensitivity to our vacancy, where we can support up to 30% vacancy and still cash flow. So we're not going to generate much return at 30% vacant, but we can still cash flow at 30% vacant on Jordan specifically. And so making sure that we have those sensitivity analysis done before we close a deal and build it is really important, just so we know what we're up against. If we were to fall back, you know, below 30%, then our guarantor steps in and is basically, that's what he's there for. So he's kind of a second backstop. And then if all hell breaks loose and everyone moves out of the apartment, then you know what happens then. So can't protect against everything, but those are kind of some of the steps that we've taken, at least on Jordan, and will do in the future to safeguard against maybe a not so bullish market.
Awesome. Solid. Thanks.
Sure. Guys, I know we're getting up at 9 o'clock. I mean, feel free to jump off if you've had enough, but if you want to stick around, we're going to hang out for a bit, answer questions, or chat with anybody that wants to. So
I'll do another one if no one else wants to go real quick. We're here on the pro forma on the income for rents. Are those actuals, or are you forecasting a little bit lower just for the sake of forecasting?
yeah, so I'd say those are like targets. Like when we put those in, that's like realistically what we think we're going to get. We always check the sensitivity to that, like I was saying before, and get comfortable with what that sensitivity looks like. But when you go to raise money, you need the accurate rents in there, because you're not going to produce the returns that you need to raise the money if you don't have what you actually think you can get in there. And maybe I don't know. I mean, if I was a different type of thinker, I would say we would project lower returns to safeguard against that and give ourselves a little bit more flexibility. But I'm an optimist, and I think if we were to miss on rent projections, like, we would just have to be honest with our investors and say, look, our analysis told us X. Like, we showed you all the comps, we showed you all the information that we were looking at, and we just missed, and we're 20% below, and we're going to do this, this, and this to help up our marketability and improve rents over time. But to a certain extent, they're along for the ride with you. And, you never guarantee anything in a real estate investment, or in any investment. You never say the word guarantee, and this is no different. We don't go to our investors and say, we promise these returns. We say, this is what the data is telling us we can make from this apartment should we be able to hit these numbers. So kind of a long-winded answer, but I hope that kind of answered the question.
Yeah, that was great.
Cool. What's that? Yeah, I know we're having trouble hearing. Anybody else have a question? There's one here from Ahmad. How granular do you guys get with your limited partners? Are you giving as much detail as you did here today, or more? They get this whole model. So this is in their hands. This is in the offering memorandum when we go to raise capital. So what we see is what they see. There's obviously things that happen throughout construction that we don't run and tell our investors, because in reality, we're going to solve the problem before it's really a problem. For example, our steel was overlapping with our brick wall at Jordan, and they thought it was going to be a delay, and they thought it was going to be a cost, and everyone was freaking out for 2 weeks. And then lo and behold, we come up with a solution that was zero cost and zero delay. So what sense would it have made to run and tell everybody before we really knew what the impact was? Now, fast forward that, and let's say we didn't find a solution, and it did cause a month delay, and it did cause a $20,000 overage. That'd be in our next investor update, and we'd have to be transparent with them. So it's a little bit. What's that?
Cash spend model.
Oh yeah, true. And so like another thing, like what we do to benchmark against this budget after we've raised is we show an actual spending budget, and we send that out with our investor update. So I guess we didn't mention, every month we send an investor update, and that includes basically just a progress. I used to write them, then I started filming them, and then we started going to the site and actually filming the actual updates of like, here's the elevator shaft, and here's the front wall, and this is the utilities, and it makes it much more interactive. And we just throw them on YouTube unlisted and send them the link with a little blurb and an email, and tell them to call us, or let us know if you want to come tour the site, and that's really all we do. And no one's asked for more, and we've gotten positive feedback on that. So that's how we kind of treat it. And we have a very transparent relationship, but I've been a little bit surprised how quiet they've been. Like, we don't really hear from them a ton, honestly. Like, one of them, I speak with the guarantor every week, just to due to his vested interest and his unique circumstance. But the rest of them I just speak to when I happen to see them in normal life, or from time to time we'll give them a call. Honestly, we should be better about proactively calling them, but to a certain extent we don't want to bug them. Like, it's going well, we don't have a problem, we're sending them updates. So that's kind of how we treat that. Here's a question, Gil. Thanks for hosting, gents. That was fun. A few questions. You alluded to some tax credits in the presentation. Can you elaborate on some of the incentives you've researched and how they fit into your financing? Do your projects have structured parking? How do you calculate parking to unit ratios? Do they typically meet or exceed zoning requirements? How do you manage and internalize the pre-development process to control consultant costs? Okay, so let's break these down. Can you elaborate on some of the incentives you've researched and how they fit into your financing? So the incentives I was talking about would be like LIHTC, like low income housing tax credits. We've never used those. We've looked into them a little bit. In fact, we had a couple of our interns this summer. Shout out Colin Petchel if you're on the call. You were awesome. And Tommy. I don't think Tommy's on, but Tommy Nodicchio, you were great as well. So we had them look into some of those programs, but we haven't ventured down that path. But to Camden's earlier point, we don't know if market rents can keep increasing at 3% for the rest of the time. Like there will be some point where we get limited growth in the market rate environment. So we want to hedge against that by getting into affordable housing. And what's unique about affordable housing is basically you don't raise equity from investors, you raise tax credits, and you sell these to banks or insurance companies or people that have huge tax liabilities that want to offset them. That's what you go and leverage your loan against, and then that's how you finance the projects. So that's about my entire understanding of it. If you want to learn more about affordable, I recommend going to Evan Holiday in Monumental Podcast. That guy almost solely does affordable development, does really, really well with it. So he's got all the insight there, and he can tell you more about it. But there's also like, we were learning about a tax credit yesterday, like the 45L.
Green.
Yeah, the green energy incentives. It's called like the 45L. And then there's one other one, but yeah, you can like qualify your units and get like a $2,000 deduction per unit if you qualify. But it's got to be less than 3 stories. And then the other one had to be like 80,000 feet or bigger. So, but I guess now that we're on the topic of tax, a really cool thing that you can do in multifamily is called cost segregation. So that basically allows you to split up all the capital improvements that you're making to the land. So basically all of your construction costs, and you can accelerate the depreciation in 5, 7, 15, and 27.5 year buckets. And there's also this bonus depreciation thing going on right now, which I think was from Trump's tax reform. And that thing allows you to bonus depreciate like 20 to 30% of your hard costs in year 1. So if we do this, which I think we're going to, basically we'll get like a $2 million depreciation in year 1, and then that will offset all the passive income throughout the life of the hold. Where it equalizes is when you hit recapture tax with the when you sell the asset. So it's just kind of a net present value play to where you can keep more of your cash flow during the hold. But nonetheless, cost segregation, really cool. Check it out. What else we got here? Post the link for Latch, please. Okay.
Sam just did that. Thanks, Sam.
Oh yeah, thanks. Yeah.
Hello? You guys hear me?
Yeah.
Oh yeah, hey.
Hey, it's Darian Stevenson here. I have a question about the consultants, right? Do you guys have to pay them for the estimates, or is it just out of kindness of their heart?
So by consultants, you mean like architect, engineer, those sorts of
Yeah,
things?
exactly, yeah.
Mm-hmm. So we have a really good relationship with Design House. They recognize that as we're pursuing new projects, it means pipeline deals for them. And we basically committed to being exclusive with them. So we wouldn't use another architect at this point. And so that security, knowing that whenever we do get one of these deals to work, helps them to justify putting in a lot of the upfront work with us and kind of coming along for the journey of doing the initial discovery and design phase is worth it to them, because they know as soon as one of these hits, then they're going to get the work. I don't think everyone does that. I don't know. We've never worked with another architect really that closely other than Design House, but at least on the architecture front, that's how we set that up. And so once that basically converts, like once we get site plan approval, then we're on the hook. Like if we go beyond site plan approval, then the rest of the contract that was deferred comes into action. Yeah, it comes in basically and is all part of the package. But we have that budgeted in the source and uses for the full amount. But it's kind of like he defers the risk for us until we know we've got a project that's approved with the city, and then we can get in. But honestly, like I said, that's kind of a unique situation, and I just recommend going out and trying to build relationships with architects and negotiating something similar, because it really helps to de-risk the exploration phase. As far as some of the other consultants, like the civil engineers of the world, or the property manager, like civil, they'll just quote what the civil's going to cost. You don't really need them for the discovery phase because the architect can do that. They can draw like ours can at least. He does the landscape plan and the preliminary site plan and then passes it off to the civil guy once we have site plan. Well, actually it'd be before site plan. So I don't know. I guess you just try to defer it as long as you can until you have as good of an idea as possible that it's going to work. And then you can start to commit to some of those costs.
Mm-hmm.
Okay. Oh, sorry. Last question. So let's say you guys get to the right before closing and it doesn't work out for you. Do you still pay the architects and the contractors, or is it just it's free for you guys?
I guess it would depend at exactly where we got to and exactly like what agreements we had with those people. Like if we were, well, first of all, like in order to get to a closing, we would have to perform a phase one. We'd have to buy an appraisal. We would have to do a number of other things that actually require us to spend money. Like in the case of Jordan, we had to put up a $30,000 bond to keep our PUD intact. So there are still a lot of expenses that come up, but I guess the name of the game is trying to push those off as long as possible so that you can still jump ship before you have hard money at stake. But inevitably you will have hard money at stake once you get that far. But for us, like if we're that far down the tracks to a closing, we're going to do everything to get it closed. And if by some stroke of bad luck it doesn't work, then yeah, we would lose the money at that point. But if we're that far down the tracks, like we have such a good idea that it's going to work and we have our site plan approval and we have our GMP estimates from our contractor and, we have the money raised for the most part, or at least we have like discussions with investors. Because a lot of times that's what does it. Like we're working on another deal right now where that's the issue. They have everything else. They have all the consultants paid for. They've self-funded all that stuff, but they're waiting on other equity, and that's what's stalling it. So that could be an issue. So you really want to make sure that you have those conversations had ahead of time as well, and that you've sort of lined up a lot of that. And in the case of Jordan, we had most of the money verbally committed to a month before closing. Anybody else want to jump in here?
Hey, what's up, man? So my name's Elijah. I work for a property management company here in Austin. I'm just curious, are you guys planning to stay in Detroit, or are you guys planning to go outside the state? What do you guys plan to do?
Right on. Yeah.
Couldn't really talk about that much, but I think for right now, since we're relatively new to ground up development, we would like to stay focused on the area that we grew up in and know very well, and that is the Metro Detroit area. But however, we have discussed a little bit about working in other, or investing in other deals around the country, but really staying focused on this area and doing that.
I'd say the hard part for us is like we have this team that we've talked about so much here, and they don't travel to Austin, so like we'd have to get a different general contractor. We might be able to still use Design House if we did Austin, but it would make the construction administration part harder, like the part that we're going through right now where they're still coming to site and they're still approving shop drawings and approving submittals, and all the shop drawings are the submittals. They're still answering RFIs and showing up to site and inspecting things. Like it's hard for them to do out of state, so we'd have to travel them down to Austin, and that would be expensive, or anywhere. I'm just using Austin because you said that. So we are interested in other places. Austin actually specifically is one of them. Denver is another one. Everyone loves Nashville too. Like a lot of these hot markets that are multifamily friendly, like we would love to venture into at some point. It would just take partnering with the right team that has a team like ours already built there. And we could come in and really do it more as an equity play and a more passive one at that.
Sure.
unless we were to really go and hire someone boots on the ground in that area to develop that team for us if we were really committed to a specific market. But all this is 3, 4, 5, 10 years down the road.
Cool. So you guys are planning on staying in with the development, then no acquisitions or anything?
We've focused there just because it actually, we didn't really choose development. It kind of chose us. We like to joke about, like, we were looking for a value add deal originally. And that's what we kept telling brokers, hey, bring us something existing. And then the relationship that Alec has brought us this ground up deal. And we're like, well, that looks interesting. Like, let's let's take a look at that. And ever since we've been focused in ground up, but I, for one, and I know Alec agrees, like, am not biased solely to ground up. And in fact, you can make similar amounts of money quicker doing value add as a syndicator. The issue is that market is so picked over right now. Like, it is so hard right now to find good value add deals. 10 years ago, they were all over the place from what I've been told. I obviously wasn't in the industry then, but everyone has been telling us, like, it used to be pretty straightforward to find one of these that you could pluck off and add value to, but right now it's just super hard to find. So I think that's another reason that we focused in the ground up a little bit more, is because, you know, there's still good pieces of land out there and we got a good team to build them. So that's where we're at right now, but we're certainly not biased, and we would definitely do something value add if the right opportunity came along. So like we said, anyone on this call that can find a good value add deal, literally consider yourself the third member of the team. You're coming inside. We'll do it together. We'll take it down, because it's that important. You know, or if you just want to take a fee at closing and, you know, not be a part of the actual process, that's fine too. But we will absolutely partner with or pay for that because it's that valuable.
Mm-hmm.
Cool.
We had a few.
Thanks.
Some coming in here. Guys, where can I find the recording of this meeting?
We'll send this out after this call. We're recording it right now, so we'll send it out via email.
Yeah, we'll shoot an email to the same group that we sent the calendar invites to. Let's see, Ben has another question. I know your roles are divided. Alec, development, Mike, PM. How are you guys splitting your time between the construction of Jordan, exciting real, the future of the Jordan, the strategic direction, other properties, the strategic growth, business vision within your own organization, and balancing it with investors? It seems easy to get bogged down without proper focus on delegation. Man, another great question. Man. So first and foremost is Jordan. We're nothing if Jordan isn't successful. So that's obviously my number one focus, bar none, is to make sure that project gets delivered on time, on budget. Mm-hmm. So above all else, that's what I worry about and, you know, lose sleep about sometimes. That allows, because I'm solely in the weeds on it, that allows Alec to be freed up and focus on other things. So you can talk a little bit about like what you do.
Yeah, I deal a lot with the acquisition sides. I scour CoStar for properties, constantly networking with brokers, debt lenders as well, just to try to find a deal that makes sense. Typically, they have great a great idea of where a property is for sale, and so it's constantly networking and punching the numbers, making sure the deal works out at and fits our mission critical criteria that we discussed earlier. So that's really what I focus on.
So to break it down by your numbers here, Ben. So like number one would be me. Number two would be like me, I guess, based on the construction, but like both of us from a strategic perspective in terms of how to position Jordan. And like, there's some ideas we have, like we want to do this thing with our property management where we offer all kinds of deals and incentives and like service-based amenities to our tenants. And we think it can actually be a revenue source for DRC somehow. And so, that's a strategic vision of Jordan. Another strategic vision is like, I'm going to join the DDA of Auburn Hills Downtown Development Authority. And Alec and I go to all those meetings already. So we're kind of protecting our interests in that way by being involved in that organization, because they're the ones that promote events and promote downtown businesses. And so by being involved there, we can make sure that the Jordan is in a market that's going to be successful, which we already really like. 3 is Alec, that'd be the other properties. And then 4, the strategic growth, business growth within your own organization, and balancing investors. That's a combined effort, really. There's a lot to that, and most of that is like I come up with in the shower, or Alec will call me about randomly. Like it's random ideas that we have that kind of get brought up, and then if they're important to do now, we add them to our daily, weekly task. If they're important to think about a year from now, we jot them down over there and come back to them. But that's kind of a fluid process. But really, our vision is real simple right now. It's get Jordan built and redo that 3 or 4 times over the next year and a half with other properties. And so it's tunnel vision on that. And of course, we have all these ideas of how we can make more money and do more things, but we just need the reps. We got to get in it and do it and be around it.
Yeah, I'd like to add too, from the strategic growth side of things, networking with individuals that have done this before and have been very successful and have built, big firms that have a development side, property management, construction management, and have really, built a massive firm. Constantly reaching out to those people, meeting with them, learning what mistakes they made, and how they built their firm is also another great thing to look at.
Right on, guys. Anybody else want to jump in for a question, comment?
Hey guys, quick
Question
question.
really quick. Oh, sorry about that.
Hey, it's Ahmad. I had a quick question. Besides Hazel Park and Auburn Hills, were there any other markets or cities that you guys were looking at?
Sorry, it was a little quiet. Did you say how we picked the market?
Yeah, so besides Hazel Park and Auburn Hills, were there any other markets you guys were looking at when you were sort of searching and scouring deals?
Oh yeah, definitely. Some of the other ones that we really like right now are Clarkston, Utica, Plymouth, Brighton, Hazel Park. We liked a lot because of like what Alec was saying, like it's kind of the growth, like the spillover growth of Royal Oak. And the reason we like all of those places kind of varies between the particular place, but like to talk about Clarkston for a second, like that's a community really near and dear to my heart. I spent the first 18 years of my life living up in Clarkston and ride my bike, downtown and everything. So I intimately know that market, and there's not a ton of new supply there. So to us, that indicates, okay, really great place, lots of great sort of sticky residents, if you will. People that live in Clarkston love Clarkston, and they just don't have the option to live in a high quality multifamily project right now. So when you kind of think that through, it spells demand. And then you look at, comps of other properties in the area, and there's not really a lot of new stuff, but there's one new one that's doing really well and leasing up in blazing speed. So again, demand. We're like, okay, we can do that because they're doing it, kind of thing. And there's safety in numbers in development. You never want to be the first person to go and take a flyer on a new market and go and build a brand new Class A right there before it's kind of proven. But it's really good to be the second or third or fourth, because a lot of times the first one doesn't catch all the demand, and the second, third, and fourth people can still reap the benefits after the first person's, taking the chance. And that's kind of how Auburn Hills was. There was one project that was built when Auburn Hills was absolutely nothing. There was nothing there. It's called Auburn Square, and it's right in downtown. It's like 90 feet from our front door. Auburn Square has been 100% occupied since it was built, has a 2-month wait list, and has been an enormously successful development. But it could have been the opposite of that too, because it was completely brand new, and it was unproven in terms of multifamily in downtown Auburn Hills. So it's kind of more of an art than a science. I mean, obviously you look at sort of the analytical, like that's the science part, is looking at the analytics of the market, the average rent, the vacancies, the employment, the median income, all of those stuff, the major employers. But it doesn't tell the whole story, and you need to think rationally about the other aspects and kind of some of the stuff that we're talking about, like, some of these qualitative factors. And that's what we look for in some of these other markets that we're mentioning. So we also are students of where other developments have happened. So like we have this huge database of where every development over the last 10 years in Metro Detroit has been built. And we graph out what the different cities are that those are in, and exactly, and all the different information about those, and then that helps to paint a picture too. Like Shelby, for example, had like 1,000 units get built there over the last 5 years. Who the hell would have thought? Shelby, Michigan, would have, or like the Shelby, Sterling Heights, Utica area over there has had, like that east side has had like crazy development. So, and that was only second to Detroit. So it was Detroit, Shelby, number 2. So you just notice weird patterns like that, and you're like, oh, weird. Like, what's over here? What's so great about this? And then you go over to Shelby or Utica. Or what's the one I'm missing? There's Shelby
Township.
Sterling Heights. What's the one we were in? Clinton Township's like all the way down there. But anyways, there's an insane amount of retail all throughout there. And so, anyways, I'm on a tangent, but that's kind of some of the stuff that we look for in the new markets and such. See, there's a new question here. How old are you guys? Super inspiring to see a new generation of developers show what is possible. Thank you, Dan. I'm 24 and Alec is 25. So we're young babies in our development career, but I feel like we've learned quick and been able to educate ourselves pretty rapidly. So anybody else? I know someone else was trying to jump in for a question there. Ben says, it would be cool if you guys posted a few books or other resources for the industry to learn and stay up on current events. Great point, Ben. I am a auditory learner. So I'm podcast all the way. I, in fact, have barely read many real estate books. Not that doesn't work for a lot of people, but I do everything through the podcast, and I feel like I can directly hear from the people I need to hear from pretty efficiently through the podcast. But I know you started reading it.
Yeah, we'll send you guys a list of the podcasts and a book that I'm reading right now. It's a ground up development, or it's a development book, but I'm not sure about what the name is off the top of my head, but it's a pretty long one.
These are a couple of books I bought off Amazon that I've sort of sashayed through. The Power of Now, Ambercount, I don't even know if that's who wrote this thing, and then The War of Art by Stephen Pressfield. Both of these are pretty solid. I've turned a few pages so far. Haven't read them all, but this one's actually really good. I did read this one, Ego is the Enemy by Ryan Holiday. These aren't real estate books, but these are just great, business and mindset books. So, anyways, there's that.
Hey guys.
Darren, did you have another question? I thought you were jumping in a minute ago.
Yeah. I just had 2 questions, 2 quick ones. How much does CoStar cost for you guys?
Yeah, CoStar's expensive, man. It's like $1,200 a month. It's crazy.
Okay. And can you send us the model that you guys are working on today?
Yeah, so we got to figure that out. A lot of, we're thinking about kind of how to distribute this thing, and we don't just want to kind of buzzing all over the place. So why don't you talk to us after, and we can talk about that.
All right, cool.
Right on.
Hey, Michael, Nick Coscarelli here.
What's up, Nick?
I live in Clarkston right now. Just had the wood shop the other night, actually.
Oh, yeah? You say you live in Clarkston?
Yeah.
Oh, right on, man. Very cool.
Yeah.
How long you lived there?
Since November. Yeah.
Cool. Oh, wow. Where you at?
But, right by Buscemi's. You know where Buscemi's is? Little party store.
Yes, to the north of town, like kind of up by Dixie.
Yeah.
Okay,
Yeah,
right on.
exactly.
Apartment up there or a house?
A house. Yeah.
Okay, cool.
I just started my career at Marks and Millichap. I'm living with my sister right now.
Right on, man.
Off commission, so keeping expenses low. But I had a question for you guys.
Sure.
We've talked about COVID a little bit, and I know you guys are, looking for new projects. What kind of conversations have you been having with your investors in terms of COVID? Are they getting spooked at all? Are they getting a little skittish for maybe some of your next projects or anything like that?
Yeah, great question. I'll tell you what our investors are getting skittish of, and that's the stock market. The thing is at an all-time high, and it makes absolutely no sense why it's there. Yeah. So I think this is actually playing to our advantage in a crazy kind of way. I think in a large sense, like, people want to diversify from the market right now. So giving them any other vehicle of wealth creation that also has these great benefits of like appreciation and equity appreciation and all that good stuff that we can sell a million times over is really attractive right now, especially in the COVID era. So certainly there are some concerns that COVID could, retain high unemployment, and there's this whole eviction moratorium going on right now, so that could spell bad news for apartment owners. So we're not immune to it, but I think despite it all, whether people are working from home or wearing masks or not, they need to live somewhere. And apartments are always going to provide that basic need. And that's kind of gets back to sort of the fundamental reason that we got into apartments, was that it is that sort of evergreen in the sense that people always need shelter, and it fulfills a basic human necessity. So we just, we'll banter that back and forth. And so far, so good with investors. Like, most of them have been sort of unfazed by what the impact of COVID will be on apartments, and more so eager to find more ways to protect or safe harbor capital into apartment developments, rather than, typical stock market type plays right now with everything going on.
You guys checked out Traverse City at all?
Garden City?
Traverse City.
Oh, Traverse City, man. Yeah, we love Traverse City. I used to have a house in on Elk Lake up there, just north of town of Traverse City. We love it up there. The issue with Traverse City in development, and our general contractor will be the first to tell you, is if you can build something in 12 months in Auburn Hills, it would take you 24 months in Traverse City.
Plus much more expensive.
The trades are incredibly more expensive and incredibly slower, and incredibly don't give a shit that either of those things piss you off. Like, there is so much demand up there that you have zero leverage as a developer or a customer. So what we'd have to do is bring our team up there. And right now, the tower's actually building a project up there right now. So we could do that.
What project?
It's actually a private residence, but nonetheless, they're doing it the same way they would do a commercial project. They are basically bringing up trades, staying in hotels, part of the construction cost, but it's still cheaper doing it that way than it is to use the trades up there and waste all the time.
Gotcha.
What is the best system for comps and market research? Good
so
question.
Definitely CoStar. I use CoStar to pull all of the properties that are in the local area, take a look at vacancy. I'll also use LoopNet and apartments.com. Sorry, no, actually, no, not LoopNet. I use apartments.com to take a look at what they're charging, what each comp is charging from another income standpoint. For example, like pet registration, monthly pet charges, how much they're charging for application fees, if they have tenant storage, how much they're charging for that. So you can really get an idea of how much your competitor is obviously charging for other income, as well as what they're currently charging for rent. But typically, I like to pull the data from CoStar and get a high level idea.
Right on, guys. Well, we're coming up to 9:37. Appreciate everyone sticking with us. Anybody have any other questions? We can answer for you. Let's see. Awesome. Thank you, guys. Hope to see you guys again. Right on, Dan. Thanks for coming, man. Appreciate you joining us.
Hey, Mike, if you have a minute, I've got a quick follow-up question.
Sure.
Gil here. So I work for a multifamily developer down here in Cincinnati, and parking is a constant conversation. So I was curious as to how you guys handle parking, the cost of providing parking, parking ratios, and whether you just meet or exceed zoning requirements.
Yeah, great question. I think you might have asked this in one earlier. Sorry for not getting to it, but that is kind of a part of that whole site plan approval process. So obviously there's what the code says, which is, a 1-bedroom needs 1 parking space, or a 1-bedroom needs parking space and a half, a 2-bedroom needs 2, whatever the code says is kind of the baseline. And then you need to see, okay, am I in a downtown? Are they going to be a little bit more lenient because downtown has excess parking and a lot of times free public parking elsewhere besides at my property? So are they going to be able to be more lenient? Or am I, a mile from the downtown where literally if I don't hit those requirements, someone's gonna be parking on the street or down the road or across the street? Like, you kind of have to contextualize it and put yourself in the planning commission's shoes to think logically about it, because it's a legitimate concern. I mean, you don't want a situation where you built a building and you legitimately can't park all of your tenants. And most of the time, the people of the cities are smart enough to figure out what that's going to be. But in the downtown, there's a lot more flexibility because there's, for example, in Jordan, we're below the zoning minimums. Like our PUD allowed us to build less parking spaces than we should have had to per the zoning code. But because there's a 238 space parking garage across the street, they were okay with it because our retail tenants are going to be able to park over there or on the 85 spaces that are kind of on Auburn Road right in front of our building. So all of that stuff plays factors into it. And really the game is always parking. It's always the issue, like almost every time. If you didn't have to park everyone, then you could build more apartments and it'd be way more profitable. But we're not all Ubering everywhere yet. So like when that happens, maybe. But while everyone still has a car, you still need to, pay for that. And then to your question about how do you pay for it, it's just baked into the hard costs, like the construction costs. So like our asphalt, for example, is a line item in our construction costs, which we didn't break out in the budget that you saw, but we have this whole budget right here from Tower where asphalt is, I think it's back here. Yeah, paving asphalt, 96 grand, $1.92 a foot, 1.4% of our total cost. And then there's also concrete over here, which covers all the curb and gutters. So sitecrete is 53 grand, $1 a foot, or 0.8% of our cost. So that's the curb and then all the asphalt, and that's basically how we, that's what it costs. And then we charge for it if it's a carport or if it's underneath the building and like covered. Like if it's any kind of premium parking space, then we charge extra for that. And it's a decent revenue generator. Like Jordan will make 20 grand off of just the parking. So it's an animal to bear. It kind of definitely influences your design and cost, but it's a necessary evil. I mean, it's inevitable to have to accommodate parking. So I hope that answered your question.
It does. Thank you.
Sure.
Hey guys, Nick here again.
Sure.
Real quick. You guys syndicated the Jordan deal, right?
Correct. Yeah, I had about 12 investors.
Okay. Alec, I know you've got a little background raising funds for Lorient. You guys see that down the road, raising some private equity?
Yeah, we've definitely talked about that. That's definitely a route that we'd like to get down or go down the path of in the future, I'd say. We've spoken to a lot of institutional investors like Simon Group Holdings and many others that are big time developers, and it definitely makes it a lot easier to obviously close on deals and fund them. So that's definitely something we would like to do in the future. But before we do that, we obviously have to prove, a track record and show that, we've been successful with investing in past deals. And, obviously in order for them to provide us funds. And
baby steps.
Yeah. Yeah. And as far as we've also talked about actually becoming like a bona fide private equity firm ourselves, where part of what we do is develop and invest in real estate, and part of what we do is own companies that help build and develop and invest in real estate.
Right.
So imagine a private equity company that then owns an architectural firm and a construction management company and all these different suppliers and trades that can then build all of your real estate investments. And the money is all one combined pool, so it's super efficient, super vertically integrated, and super, super profitable. And that is an area that I'd say we're entrepreneurs at heart. We're not beholden to real estate. We're real estate junkies right now because that's our business, but we won't be, I don't know, I don't want to say for sure, but I feel like we'll be more diverse in the future and kind of branch out into other areas as well. Mm-hmm. And that's one area that we can kind of combine our previous backgrounds with our current lifestyle, I guess, our current jobs.
Yeah. Yeah, I kind of got the same thing written down in my OneNote. Basically the
There you
exact
go,
same
man.
concept, man.
Yeah, well, let's get coffee and talk about it.
Yeah, no kidding.
Right on, man. Absolutely. Anything
All
else,
right.
guys?
Thanks, guys. I appreciate it. I got to take off here.
Right on,
No
man.
problem.
Have a good night. Thanks for joining us.
You too. See ya.
Michael, Alec, great presentation overall. I really appreciate this on the whole. Great value provided. I look forward to the next presentation and the next conversation. Thanks, guys.
Thanks,
Awesome.
Ahmad. Thanks for joining, man.
Thanks a lot, Ahmad. Really appreciate it, man.
Take care.
We'll keep you in the loop and we'll send out all the follow-ups afterwards so we can all stay in touch.
Yep. Thanks again.
Thanks, Travis. Appreciate it. Adios.
See you guys. Thank you.
See you, Ben.
Later, Ben. Thanks for the questions.
Yeah, good questions,
Thanks for joining, brother.
See you
Take it
around.
easy.
Thanks, Mike. This was a lot of fun. Long time no chat. It was good to see
Yeah,
you.
man. Been too long. Did you say you're in Cincinnati or was that someone else?
I am in Cincinnati. I live in northern Kentucky and I work in Cincinnati.
No way. Well, that guy that just got off is also living in Cincinnati and is in development. So you guys should connect.
Oh, fantastic. If you could send me his name, I missed it.
Yeah, sure. Ben Elliott. I'll send you his number and I'll send. Actually, I don't even know if I have your number. Let me see here.
I can send it to you on LinkedIn.
Good. Perfect.
Yeah, that
way-
works. Just fire me over a message and then I'll connect you guys. But yeah, man, that's awesome. Congrats. Next time you're up in the Michigan area, let's grab coffee and connect.
Absolutely. I'd love to get a tour of the Jordan as well. I'll bring my hard hat.
Absolutely, brother. Absolutely. Love to show you around. Yeah, just text me and let me know.
Will do. Thanks, guys.
Yep,
Adios.
thank you.
All right, guys, look like we got 2 left here. We're going to go ahead and just end the meeting. So thank you again to everyone for joining. I guess there's only 2 people left, so I've been talking to. But thanks a lot, guys. We'll send this stuff out and appreciate you guys coming by.
Yeah, thanks, guys. Appreciate it.
Thanks a lot. Bye-bye.